Welcome, Pure investors. I'm Nick, and this is your July update for the Pure Income and Growth Fund. First, a quick comment on the year that was. The combined impacts of rising inflation, interest rates, and political tensions, catalysed in part by the war between Russia and the Ukraine, drove an acute market correction, returning all equity gains made since December 2020. This was the second major market correction since Pure's inception in 2018, the first being the February-March 2020 pullback on COVID's initial global spread. In the first market correction of Pure's life, the fund's capital preservation dynamics came to the fore, with a total drawdown on the unit price of 5.9% across February and March 2020, whilst the All Ordinaries declined over 30% in the same period. They say 2 data points makes a trend, and pleasingly, the capital preservation strengths of Pure's model have proved themselves once again in FY22, with the fund delivering a positive 0.5% return for the financial year versus a double-digit decline in the All Ordinaries Total Return Index. We're happy to say this trend has continued in early FY23, with the fund delivering plus 1.3% in July. And whilst we expect markets to remain difficult through FY23, there are reasons to be optimistic about the outlook for the fund. Firstly, the demand growth for capital from our target cohort of companies has increased at least sixfold in dollar value versus the same time last year. To say there are a plethora of listed companies who are unhappy with their cost of equity is an understatement. We literally cannot keep up with demand, either in the workload sense nor funds available to deploy. Pleasingly, having begun an active campaign to raise more capital into the fund 2 weeks ago, August inflows have been strong. But if you enjoy the capital preservation and quarterly cash distribution attributes of the fund and are considering further exposure, we would encourage you to consider investing now. To do so, please visit our website at www.puream.com.au or contact a member of the Pure team. In addition to our addressable market significantly expanding of late, the asymmetry of risk in the portfolio has never been this compelling. Warrants and equity are now less than 10% of the NAV, and this means no single investment can materially impact the unit price in a negative way, should it be subject to a further material fall in equity value, which we think is unlikely from here. Similarly, 6 of our 8 private investments are held at credit value only, reflecting no value for the equity component of the exposure that we hold, and each does have equity value. Third, all credit positions are performing well, paying interest on time with no events of default triggered or expected. And finally, we're seeing a modest improvement in the commercial terms that can be realised on new transactions, with affordable growth capital now well and truly scarce. Now let's turn to this month's commentary on the fund. We're pleased to announce a new tranched $10 million corporate loan and warrant facility for Kleos Space, ASX code KSS. The terms of the facility are a 12% interest rate, senior secured, with 100% warrant coverage converting at a 70% premium to the prevailing share price. Kleos is one of the more impressive companies that we've analysed. The company operates clusters of satellites in low Earth orbit that receive and precisely pinpoint the geolocation of particular radio frequencies. This data is then sold to government intelligence and defence agencies. Kleos recently announced its first €900,000 contract with a European defence body that can't be named, and in a market update to investors in May, flagged a pipeline of over 260 qualified deals. Pure's funding will see the company through to its target of positive EBITDA in the second half of this calendar year, as well as supporting the launch of its 4th satellite cluster. This will be a fun one to watch, we think, and no doubt they will be watching us at the same time. We look forward to keeping you updated on Kleos. Turning now to DXN. In further positive news for the portfolio this month, modular data centre play DXN, where Pure is both the senior secured creditor and has exposure to approximately 18.5% of the equity in the company through both direct equity and in-the-money warrants, has received an asset purchase offer for all of the company's assets. The estimated per-share capital net proceeds to equity investors is in the range of 1.1 to 1.3 cents per share versus the last close price prior to the announcement of 0.5 cents per share. Concurrently with the asset sale announcement, DXN raised a modest amount of equity capital at 0.85 cents per share. Pure supported the raise and will make a material return on this equity investment versus the asset purchase price. Further, the raise has reset the conversion price of Pure's warrants, and Pure will make a material return on its exposure here. With the consummation of the transaction still subject to FIRB approval, which involves one sovereignly sensitive asset in the business, which will be carved out of the purchase if FIRB so requires, it is not currently possible to calculate the annualised return, but needless to say, it's a healthy one. And finally, turning to the fund's second ever investment, Carbon XT, the company has embarked on what we consider a game-changing expansion. Term sheets have been signed and the capital raised for the financing of a 50% ownership in a new, state-of-the-art activated carbon plant in Eastern Kentucky, USA. The project is in collaboration with KCP, an established, well-capitalised and well-connected participant in the US market. Carbon XT has indicated that at nameplate capacity, the new plant will generate almost 70 million, that's Australian dollars, of revenue and 35 million of gross profit per annum, of which Carbon receives a majority share. With substantial interest in offtake agreements for the new facility, Pure has significantly expanded its facility with Carbon and been issued a new material tranche of warrants. We expect the new plant to be revenue generating in the fourth quarter of FY23 and will provide further updates on the company as progress is made. Thanks for your time, and we look forward to updating you again next month.